The food delivery industry has experienced unprecedented growth since 2020, but not all companies have managed to stay afloat in this highly competitive market. Today, we're diving deep into 15 food delivery services that are teetering on the edge of bankruptcy, revealing the complex factors that have led to their current predicament. Let's start with Foodora, once a promising player in the European market. Despite its initial success in countries like Germany and France, the company has been struggling with mounting debts exceeding $200 million. Their operational costs have skyrocketed while customer retention has plummeted. The company recently laid off 30% of its workforce and closed operations in several key markets, indicating severe financial distress. Next up is Grub South, a regional player in the southeastern United States. What started as a promising local alternative to major delivery services has turned into a cautionary tale. Their attempt to expand too quickly into neighboring states has left them with unsustainable operational costs. Their revenue dropped by 45% in the last quarter, and they're currently seeking emergency funding to avoid complete shutdown. Delivery Hero's subsidiary, Talabat, operating in the Middle East, is another concerning case. Despite the region's growing delivery market, Talabat has been losing market share to aggressive competitors like Careem Now. Their customer acquisition costs have doubled in the past year, while their driver retention rate has fallen to an all-time low of 15%. The company's debt-to-equity ratio has reached alarming levels, suggesting a potential bankruptcy filing by mid-2025. Moving to Asia, we find HungryPanda, a service targeting overseas Chinese communities. While their niche market strategy initially seemed promising, the company has failed to adapt to changing consumer preferences. Their exclusive focus on Chinese cuisine has limited their growth potential, and their technology infrastructure has fallen behind competitors. Recent financial reports show they're operating at a 60% loss, with cash reserves rapidly depleting. Caviar, once a premium delivery service acquired by DoorDash, is now struggling to maintain its position. The company's attempt to maintain high-end restaurant partnerships while competing with more affordable services has created an unsustainable business model. Their average order value has decreased by 35%, while restaurant partnership costs have increased by 50%. In South America, Rappi's ambitious expansion plans have led to serious financial troubles. Despite raising billions in venture capital, the company's burn rate has become unsustainable. They're losing approximately $3 million per day across their operations, and their attempt to diversify into financial services has only added to their troubles. Waitr, now operating as ASAP, has seen its stock price plummet by 95% since its peak. The company's rebranding effort failed to address fundamental issues with their business model. They're currently operating in only a fraction of their original markets, and their quarterly reports show concerning trends in both customer retention and revenue generation. Deliveroo's Australian operations have been particularly problematic. The company has struggled to compete with Uber Eats and Menulog in the region, leading to significant market share losses. Their attempt to implement a subscription model has failed to generate expected revenues, and they're now considering completely withdrawing from the Australian market. Wolt, despite its successful acquisition by DoorDash, has been struggling in several European markets. Their expansion into smaller cities has proved unprofitable, and their technology infrastructure costs have exceeded projections. The company's operating losses in Eastern European markets have doubled in the past year. Just Eat's American venture has been particularly troublesome. Their attempt to penetrate the U.S. Market has resulted in massive losses, with customer acquisition costs reaching unsustainable levels. The company has already withdrawn from several major cities and is considering a complete exit from the American market. Postmates, even after being acquired by Uber, continues to face significant challenges. The brand has lost its distinct identity, and many of its loyal customers have migrated to other services. Internal reports suggest that the division is operating at a significant loss, with no clear path to profitability. FoodPanda's European operations have been particularly concerning. The company has failed to maintain its market position against aggressive competition from Deliveroo and Just Eat. Their attempt to implement automated delivery systems has resulted in significant capital expenditure without corresponding returns. GoPuff's rapid expansion has led to serious financial strain. The company's promise of ultra-fast delivery has proved costly to maintain, with their dark store model requiring significant ongoing investment. Recent reports indicate they're burning through cash reserves at an alarming rate. Chow Now, despite its different business model focusing on restaurant partnerships rather than delivery services, has struggled to maintain profitability. Their commission-free model, while attractive to restaurants, has failed to generate sufficient revenue to cover operational costs. The company has already reduced its workforce by 40% and is seeking emergency funding. Finally, we have DoorDash's subsidiary, Bebot, which focuses on in-restaurant ordering technology. While not a traditional delivery service, their financial troubles highlight the broader challenges in the food service technology sector. Their attempt to compete with established point-of-sale systems has proved more difficult than anticipated, and they're currently operating at a significant loss. These companies' struggles highlight several common themes in the food delivery industry. First, the fundamental challenge of achieving profitability in a business with thin margins and high operational costs. Second, the difficulty of maintaining customer loyalty in a market with minimal differentiation between services. Third, the impact of rising labor costs and regulatory challenges across different markets. Looking ahead, industry experts predict a significant consolidation in the food delivery market. Many of these struggling companies will likely be acquired by larger players or forced to cease operations entirely. The survivors will need to focus on operational efficiency and finding sustainable competitive advantages beyond price competition. For consumers, these developments could mean fewer options, but potentially better service from the remaining players. For restaurants, it might lead to more favorable terms as delivery services compete for their business. The key question remains, can these companies find a path to profitability before their resources run out? The food delivery industry's future will likely belong to companies that can effectively balance technology investment, operational efficiency, and customer service while maintaining sustainable unit economics. The current wave of potential bankruptcies serves as a stark reminder that even in high-growth industries, fundamental business principles cannot be ignored. As we continue to monitor these developments, it's clear that the food delivery landscape will look very different by the end of 2025. The companies that survive will need to demonstrate not just growth, but a clear path to sustainable operations and profitability.